Hey everyone, George here. So a question I get a lot from my contractor clients is how exactly should I pay myself? So a lot of them treat it like it's their personal ATM. They just, take out money as they please. But today I'm going to teach you the right way how to pay yourself from your business. So let's get started. So I think a lot of us are familiar with the famine or feast nature of the construction business. You could have some dry spells, but then you have some large projects coming through and large checks. You've also got payroll, materials, subs, insurance, equipment, fuel, and hopefully no OSHA fines or anything like that. But if you don't pay yourself properly, two things can happen. Number one, your books get messy, which messes up your ability to get loans or bonding. And number two, in the event of an audit, the IRS can treat incorrect payments like taxable income. So today we're going to go over exactly how to pay yourself. And this all comes down to the entity type on how you're structured. So the first one we're going to cover is sole proprietorships or single member LLCs. So if you're either a sole proprietor or a single member LLC, meaning an LLC that you 100% own, the IRS doesn't see a difference between you and the business. If you are a single member LLC, you do have that extra limited liability protection from the state, but for purposes of the IRS, you are one and the same. So how do we pay ourselves if we are a sole proprietor or a single member LLC? The answer here is pretty simple. Owner's draw. There's no payroll, no W-2. As a matter of fact, you're not allowed to pay yourself a W-2 on a Schedule C. You literally just transfer money from your business account to your personal account. Now, a lot of people here ask, okay, then how exactly am I taxed? Am I taxed on the money that I take out? The way it works is you report your business income on your Schedule C of your personal tax return. You pay self-employment tax on your net profit, not how much you take out from the business. So for example, if a job paid you $40,000 and you spent $30,000 for that job, on material subs, things like that, everything else, you're basically taxed on $10,000, whether you leave that $10,000 in the business account or whether you take a distribution, a draw, and put it in your personal account makes no difference whatsoever. At the end of the day, you're taxed on the $40,000 minus $30,000, the $10,000. Now, the second entity type, if you're either a partnership or a multi-member LLC. Now, if you've got a partner, again, similar to sole prop or single member LLC, you cannot pay partners as W-2 on payroll. Again, you're not allowed to do this, similar to a sole prop or single member LLC. Partners get paid through what's called a guaranteed payment. These are like salaries for partners. They're deductible to the partnership and they're treated as income to the specific partners. And they're subject to self-employment tax, income tax, all that. Now, the second way you could pay yourself as a partner in a partnership is through a profit distribution. Now, it's one thing to take a draw or a distribution when you're a single member LLC or sole prop because it's all you, it's your business, it's your money, business or personal. However, if you're a partner, I would really keep it to the partnership agreement. Any distributions, everybody would need to be in cahoots on how much everybody's taking a draw on. Otherwise, it's going to rile up your partners pretty quick when you're taking out more money than them, and in all truth, it wouldn't be fair. So partner distributions would not be subject to self-employment tax the way guaranteed payments would. That is one benefit, but again, you have to follow the partnership agreement. And if you don't have one, I highly recommend you agree with your partners and get one on file. Now, I mentioned for both sole props and single member LLCs, as well as partnerships, how any distributions are not subject to self-employment tax, and that's true. They're not subject to any tax, whatsoever because you're already paying tax on the earnings. However, if you take distributions out in excess of earnings, then it could be subject to capital gains tax. And this really happens when if you were to go get a loan from a bank and then take out that loan and go spend it on personal reasons, renovating your house or doing whatever with it, that's when it would effectively trigger capital gains tax. But assuming that you're, like in our one example, if you have the $40,000 from the job minus $30,000 in expenses, as long as what you distribute is $10,000 or less, you're not subject to any taxes on that distribution. Now, if you went and got a loan for another $10,000 and you took that full $20,000 out, you would be subject to capital gains tax on that additional $10,000 that you took as a loan. Now that gets kind of into the weeds. I wouldn't worry too much about it. The moral of that story is don't go getting a loan and distributing it to your personal the next day. Now we covered sole prop, single member LLCs, and partnerships. The next one up is S corporations. So most contractors switch to an S corp eventually. Once your taxable income becomes $80,000 or higher, I would really urge you to convert your LLC into an S corp, or you could have a regular C corp and convert it into an S corp. It's just more tax advantageous to do that. Now, how do you pay yourself if you are an S corp? Now here you must pay yourself what's called a reasonable compensation, because the IRS wants their cut of Social Security, Medicare, the FICA taxes. And with an S corp, since technically it's a corporation, any draws from the S corporation are not subject to self-employment taxes. But this is why you have to pay yourself a reasonable comp as a W-2 employee, as an officer of the business, and that's because they want their cut of that FICA. So again, for sole prop, single member LLC, and multi-member LLC and partnership, you can only pay yourself either through a draw or guaranteed payment in the case of partnerships. However, for an S corp, you need to pay yourself a W-2. You can't pay yourself W-2 in the other entity structures we spoke about, but for an S corp, you must pay yourself a W-2, a reasonable wage. Now, what is a reasonable wage? The IRS looks at your role, your skill level, the industry, and ultimately what you would pay someone else to do what you do in your market. But this is where the magic of an S corporation comes in. If your S corp makes a $300,000 profit, you can pay yourself $80,000 through W-2 payroll. And you'd pay the FICA, all that, Social Security, Medicare on that $80,000, and you can take the remaining $220,000 out as a distribution, and you would not pay the self-employment taxes on that $220,000. Now, if you were a regular single member LLC or a partner in a partnership or multi-member LLC, you would all be paying that self-employment tax on that $300,000. So that is definitely the nice thing with an S corp. But again, S corp, you have to W-2 yourself. Finally, we step into a C corporation, and most contractors are S corporations. However, as you're scaling, as you're getting bigger, you need certain benefits and more sophisticated tax planning strategies. You will most likely at some point have to set up a C corporation. Not that you have to, but it will be to your benefit big time. With a C corp, the way it works is the C corp pays a 21% flat tax on its effectively net profit. And then you as the owner can take out money in one of two ways, either through a W-2 payroll or through dividends. Now the problem with the dividends is it gets taxed twice. If you were to take out your full compensation in the form of dividends, you're paying tax at the C corp level, that 21%. And again, you're paying tax at the personal level. Technically, it would need to issue you a 1099. So in this case, a W-2 salary is the better option. But again, I always recommend to my contractor clients, usually the life cycle goes, somebody starts as a sole prop, they're just kind of doing things ad hoc, taking jobs as they come. Then they form an LLC. Then they convert the LLC to an S corp, and as they get more sophisticated, get employees, start scaling, start wanting more tax strategies, more tax planning, save on taxes, they also form a management company or a C corp. And there's a lot of benefits to that, which I'll have to cover in another episode. It's a whole other can of worms. Now, we've effectively covered all the entity types and how to pay yourself from each. So what I want to cover next are what are the biggest mistakes contractors make when they pay themselves. Number one is mixing personal and business accounts. And I'm sure you've heard this a million times, but if you're making things really obvious for anybody potentially auditing your general ledger, like you're buying diapers and drill bits from the same account, I mean, this kind of raises red flags, and any, reasonable human being would start questioning everything. That's number one. Don't mix up, business and personal. Number two is ignoring the payroll requirement for S corps. If you file your 1120S, your S corp tax return, with line 7 left blank, that is a huge red flag to the IRS, and I would not recommend you do that. So you need to get your W-2 straightened out. If you are an S corp owner, you need to pay yourself a reasonable compensation. Number three is taking out too much too fast. The problem with this is when things get out of control of when you're taking distributions, like say you're just a regular LLC, People, they take out money too fast. Maybe their lifestyle requires it or whatever it is. And then they get financing to try to, make the business cash flow. And then they end out taking even more money. And this triggers a capital gain, this excess distribution. And I highly advise against that. This was big during COVID times with the EIDL loans. I saw a lot of people, unfortunately, they would go get the EIDL loan, get the PPP, and they would take out all that money, go remodel their house, go on a vacation, do all these personal things with it, and come tax time, and there was a lot of capital gains being like triggered. So that was definitely a different time with a lot of excess distribution. So don't do that. Don't take out too much money. Keep things kind of steady. Like keep yourself on an even keel. Whether you're an LLC, S corp, pay yourself square amount like every month, every couple of weeks, whatever it is. And number 4 biggest issue I see is no bookkeeping. And that's really a problem because, if God forbid we get audited, it just makes your life all the more difficult. They need to get comfort over the completeness and accuracy of the information that you provided to them. And, if there's no formal set of books that could be vouched to bank statements and then ultimately to receipts, that's going to be a big problem. It's going to be a huge headache. So again, to make full circle, which method is the right one for you? If you're a sole prop or a single member LLC, keep it simple. You can just transfer money from your business account to your personal account. As long as it's coming out of your earnings, meaning you didn't just take out a loan and distribute that money, you should be fine. If you're a partnership or a multi-member LLC, please have an agreement on record. If you're going to take any distributions, make sure it's within the realm of the agreement and everybody's on board. And otherwise, you're going to have to take guaranteed payments. If you're an S corp, you need to W-2 yourself for sure. Beyond the W-2ing, you can pay yourself via distributions. And if you're a C corp, I would highly recommend you W-2 yourself. If your C corp is a part of your larger web of entities, you don't necessarily need to W-2 yourself. But again, if you do pay yourself dividends from a C corp, you're going to get double taxed. If you need help setting up your payroll, cleaning up your books, converting to S corp, tax planning, click the link below, book a time. We're here for you. This is what we do all day long. We work with contractors. Almost all our clients are contractors. I hope you found this helpful. Click like, subscribe, turn on notifications for any updates, and hope to see you in the next one.